Good morning and welcome to Charting the Markets on Wednesday, the 14th of February 2024. Yesterday's hotter than expected US inflation print sent equity markets down toward the S&P 500, Nasdaq 100 and Dow Jones Industrial Average from their record highs, and led these to drop by about 1% or more. And the brunt was actually borne by the US small caps, with the Russell 2000 index dropping by nearly 4% on that higher inflation print. Now, what is interesting is that the market participants have pared back their rate cut expectations from now May. You may remember back in October of last year, we were expecting a first rate cut to be seen by the Fed in March, but that was pared back to May, and then yesterday even further back to the June meeting. And we also saw the size of the anticipated rate cuts drop from about 160 basis points of cuts expected at the end of October of last year to now around 90 basis points. And on that inflation print, the US Treasury yields rallied quite significantly. We had the 10-year Treasuries rising by about 10 basis points. And we also saw, in line with that, the US dollar appreciate, and we'll look at that later on. But let's begin by having a look at the FTSE 100. And as we can see here on the daily financial bet, we've had this sharp decline yesterday take us down to 7,464. And you may be wondering why we are now seeing this bullish reversal take us back up above the 200-day simple moving average here in red at 7,545. And the reason for this is that UK inflation held steady at 4%, and core inflation also coming in steady at 5.1%, both of which were lower than expected. And despite wage growth coming in above forecasts, and therefore us expecting to see the first rate cuts by the Bank of England only in August of this year, the equity markets have risen and responded quite favorably to that softer inflation reading in the United Kingdom. And you can see here, the FTSE 100 is actually leading the way with regards to other European stock indices, in that it is reversing its downtrend and rising by close to 1% so far. So where's the next upside target? Well, we've got the early February lows around 7,600, and also the orange line here at 7,609 to look forward to. If we were to manage to break above that orange line, the 55-day simply moving average, we could actually continue to advance back towards the January high, the late January high at 7,690, and also the 7,710 current February high. So this resistance area between 7,690 and 7,710 is a possible upside target, provided the current bullish reversal were to continue in the days ahead. Now, from a technical perspective, we need to hold above yesterday's low, though, at 7,464, and also need to hold above this uptrend line going back to October of last year, 7,450, for this bullish scenario to remain valid. Now, in Germany, the German DAX index took a hit yesterday. As you can see here, we slid back to our key support area at the beginning of February to 16,782, but did find support there and are trying to regain some of those losses from yesterday at the moment. And with the economic calendar being relatively empty, and as we've just seen, Eurozone GDP, the second preliminary reading, coming in slightly better than expected, but basically GDP in the Eurozone being flat, we had a small move to the upside, but it hasn't really managed to take out yesterday's high, which would have to happen for us to remain bullish from a medium-term perspective, and that came in at 17,010. And I wouldn't be surprised if in the course of today we may actually falter ahead of that high from yesterday and perhaps slip back towards the lows seen yesterday. Now, if we were to fall through yesterday's lows and also the lows from early February, as I said, 16,782, we would then most likely not just test the orange line here, the 55-day simple moving average, 16,741, but also probably slip back towards the 16,600 to 500 zone as we enter a seasonal phase where equity markets do tend to underperform the most during a year, and that is in the last 2 weeks of February. So interesting times ahead. For now, the uptrend still valid as we've held above these early February lows at 16,782, and as long as that's the case, we could see further sideways trading. For the bulls to be back in control, we need to rise above yesterday's high at 17,010, and if we were to fall through 16,782, we may actually consider us to have formed some sort of top formation and could then slide much further than we've seen recently. The story is quite similar with regards to the Dow Jones Industrial Average. As you can see here, yesterday's fall by nearly 1.3% has taken the index through the October to February uptrend line. But here we've also held more or less around the early February lows. And basically, as long as we stay above yesterday's low at 38,037 on the daily chart closing basis today, we may see an attempt to the upside again. But if we were to fall through 38,037 yesterday's low, we would most likely retest the highs going back to January of this year. And these were made around the 37,820 to 16 area. And below there, we also have a possible downside target at the 55-day simply moving average at 37,491. So short term, it looks as if we are now entering a consolidation phase with regards to equity indices, as inflation in the United States came in higher than was previously expected and pushed back rate cut expectations. Now, I mentioned that the rising yields in the US on that higher inflation print yesterday led to strength in the US dollar. And you can see that in a moment when I look at the British pound against the US dollar chart. But before I do so, I would like to look at the euro against the British pound. You can see here the British pound is depreciating today on that inflation print in the United Kingdom, when we saw inflation come in at 4%, as was the case in December, and also at 5.1% with regards to core inflation, both of which came in softer than expected. And on that softer inflation print, we have the euro accelerating and appreciating versus the British pound, because now the Bank of England is expected to cut its rates for the first time in August of this year, so later than had previously been expected, and hence we're seeing some British pound weakness. And as you can see here, we basically dipped down to a 5-month low yesterday at 84.99, but are bouncing back off that broken through downtrend channel resistance now because of inverse polarity as support line. And we seem to be heading back up again towards Friday's high at 85.47, which needs to be taken out for us to form a bullish reversal pattern. From a medium-term perspective, we also need to take out the 5th of February high at 85.72 for us to make a complete reversal pattern. So this hasn't happened yet. Short term, we're just bouncing off a 5-month low, and it looks as if a further upside could be in store over the next few days on that weaker British pound reading. And you can see here the impact on that on the British pound against the US dollar. As I said yesterday, the US dollar appreciated quite strongly, and we were trading higher at a 1-week high at 126.92 on cable before this US inflation print that was hotter than expected took us down to the red line, the 200-day simply moving average, yesterday at 125.65. And today, on that softer than expected UK inflation print, we actually slid through the 200-day simply moving average and also through the October to February uptrend line, which now means that we are heading back down again towards the low seen back in December and also early February of this year at 125.19.201. So that's the support area which is being targeted by cable. If we were to fall through it, the next downside target would probably be the early November at 124.28. But yes, short term, we're definitely heading down again. Minor resistance now coming in at this breached uptrend line and also along the red line, the 200-day simply moving average at around 125.65. Another interesting currency pair is the US dollar versus the Japanese yen, and you can see here that we have risen right through the psychological 150 yen mark and nearly hit the 151 yen area yesterday before we saw some Japanese policymakers from the Bank of Japan verbally intervening. And you can see the effect of that is that the upside thrust here has slowed down with regards to dollar yen. But from a technical perspective, provided we stay above the last reaction low, that's to say the low from Monday at 148.93 on a daily chart closing basis, we should continue to head higher towards the record highs going back to October and November of last year between 151 yen and 73 sen and 151 yen 91 sen here. So that's the key target area, which is once again in view, but we'll have to see whether we could see some intervention by the Bank of Japan, and that would then probably lead to another decline in the currency pair if that were to happen. The oil price is interesting because yesterday we saw the 7th consecutive day of gains for Brent crude oil, and I think I forgot to put it onto this chart here and just added the gold price. So let's talk about gold first. And you can see here that the gold price dropped by over a percentage point yesterday on that higher reading by the US inflation data of January. And we can see here that we actually this morning fell even further to $1,987 per troy ounce. And there we are now basically trading below this key support area made up of the October and mid-November highs and also the early November low between $2,009 and $2,002 per troy ounce, which now should act as resistance, because once support gets broken through, it becomes resistance because of inverse polarity. And as you can see here, the thrust to the downside has taken us to levels last traded in mid-December of last year, so to a 2-month low. And we are now heading down towards the December low at $1,974 per troy ounce, and also the red line, the 200-day simply moving average, $1,967 per troy ounce. So these are the target areas for the gold price as the US dollar continues to appreciate. And looking at the silver price, we can see here that the price of silver has fallen as well. As we can see here, we are now heading back down again towards the lows seen at the end of January at around $21.93, and also the November lows at $21.89, which so far have acted as support. As you can see here, we're just about holding that at the moment. But if we were to fall through these lows, which looks pretty likely at the moment, given the rate of descent we saw yesterday on the silver price, well, if we were to fall through $21.89 per troy ounce, we would be falling back to levels last seen in October of last year, and that would then take us probably back down again towards the $21 mark, and perhaps the October low at $20.69. So that is a distinct possibility, provided we stay below Monday's high at $23.07, which is markedly above the December to February downtrend line. Now, I know that I've mentioned Brent crude oil, so I'll quickly have a look at that. And you can see here that Brent crude oil continues to rise. We've had 7 consecutive days of gains so far, and seem to be on track for our 8th consecutive day of gains, which has now taken us above the red line here, the 200-day simply moving average on this front month futures contract at 81.61, and we seem to be heading back up again towards this key resistance area made up of the October low, the mid-November high, the late November high, and also the January high. And when you've got a cluster of previous highs and lows, those usually represent a pretty important and significant technical resistance area or support area, but in this case a resistance area, and it comes in between 83.12 and 84.58, and that's where we are heading towards with regards to the Brent crude oil price at the moment. Thank you very much for watching Charting Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.